Key U.S. business tax planning for the end of 2025, start of 2026. As the end of the 2025 tax year approaches, U.S. business owners face a crucial window for strategic tax planning. Recent legislative changes, particularly the One Big Beautiful Bill Act, signed into law in July 2025, have introduced significant permanent shifts to key tax provisions, making year-end review and action more vital than ever. The primary goal of effective year-end tax planning is to actively manage taxable income by either accelerating deductions into the current year, 2025, or deferring income into the next, 2026, all while utilizing newly enhanced credits and expensing provisions. 1. Maximize capital investment deductions via Section 179 and bonus depreciation. One of the most impactful changes involves the permanent restoration and enhancement of accelerated depreciation methods, specifically Section 179 expensing and bonus depreciation. The One Big Beautiful Bill Act permanently restores 100% bonus depreciation for qualified new and used property acquired and placed in service after January 19, 2025, a significant reversal from the scheduled phase-down. Additionally, the maximum Section 179 deduction limit has more than doubled to $2.5 million for tax years beginning in 2025, with the phase-out threshold increased to $4 million, as per IRS 2025 instructions for Form 4562 and U.S. Bank. This enhanced ability to immediately deduct the full cost of equipment, machinery, and software provides an extremely powerful incentive for businesses to make planned capital purchases before December 31st, 2025. 2. Strategic timing of income and expenses. A fundamental and timeless tax strategy is the management of when income is recognized and when expenses are paid. For businesses operating on a cash basis or for accrual basis taxpayers with flexibility, this year-end timing is critical. If your business anticipates a lower profitability or a lower tax bracket in 2026, you may want to defer income, such as delaying invoicing until January 2026, and accelerate deductions, such as prepaying January's rent, ordering and paying for supplies, or issuing employee bonuses that are paid before year-end into 2025. Sourced from J.P. Morgan and Cherry Beckeret. Conversely, if you foresee higher income or tax rates in 2026, you would do the opposite, accelerate income and defer expenses. 3. Utilize enhanced research and development expensing. Another significant benefit of the One Big Beautiful Bill Act for businesses engaged in innovative activities is the reinstatement of the immediate deduction for domestic research and experimental expenditures. Taxpayers can now fully deduct domestic research and experimental costs incurred in tax years beginning in 2025, rather than capitalizing and amortizing them over 5 years, as previously required. Source being IRS 2025 instructions for Form 4562. Furthermore, small businesses with average annual gross receipts of $31 million or less can even retroactively deduct unamortized costs from 2022 to 2024 by filing an election statement with amended returns. Source Cherry Beckeret. Businesses should immediately review their innovation-related spending to capture the substantial immediate tax savings. 4. Maximize tax advantage retirement contributions. Establishing and funding a qualified retirement plan remains one of the most effective ways for business owners to reduce their taxable income for the year. Contributions to plans like SEP IRAs, solo 401ks, or traditional 401ks are generally deductible by the business. For 2025, the limits on both employee and employer contributions have increased. offering more tax-deferred saving space. For example, the employee elective deferral limit for a 401k rises to $23,500 for 2025. Source: Paychecks. Small business owners should consult with a tax advisor to ensure both employer contributions and any deductible personal contributions for the 2025 tax year are made by the respective plan deadlines, which may extend up to the tax filing due date, including extensions for certain plans. Source: Intuit TurboTax. 5. Review and claim available business tax credits. Beyond deductions, businesses should proactively review their eligibility for valuable dollar-for-dollar tax credits. The research and development tax credit remains a prime opportunity for companies involved in technological or process improvements. Other beneficial credits include the Work Opportunity Tax Credit for hiring individuals from targeted groups, the Employer-Provided Child Care Credit, and various energy-efficient commercial buildings Section 179D incentives. Source: Cherry Bekaert. These credits directly offset tax liability, providing a far greater benefit than an equivalent deduction, and many require specific documentation or investments to be completed before the end of the tax year. The confluence of permanent changes and enhanced limits resulting from the One Big Beautiful Act, along with the typical year-end strategies of timing expenses and income, creates a highly dynamic environment for 2025 tax planning. Business leaders should not rely solely on the accounting systems, but must engage with tax professionals immediately to model the impact of these changes. Taking timely action now, especially regarding major capital expenditures, research and experimentation activities, and retirement funding, will ensure maximum tax efficiency and a strong financial footing as you transition into 2026. For more informative tax and business-related videos, we welcome you to subscribe to our YouTube channel. Thank you.